Alright, starting tomorrow, every government in the world honestly decides to repay all their debts. Just tell us where to send the money. Wait, where exactly? Who do they actually pay? Is there some kind of one global wallet? Sarkis here, and right now I'm going to break down the idea of global debt quickly and in plain English. Where did it even come from? Who owes whom? Where is the real pressure point? The one that makes banks, currencies, and markets nervous. And how are you personally financing government debt and quietly making yourself poor? Hit the like button and I'll explain it in the simplest way possible. Global debt sounds like one giant loan taken out by the entire planet. In reality, it's just the total debt of different sectors, governments, households, and companies. That's why the numbers vary. The IMF estimate it at around 111 trillions, but the Institute of International Finance has mentioned figure closer to 350 trillions. So, is someone lying? Not necessarily. They are just measuring different things. Some include more of the financial sector, some focus on non-financial debt. Not all countries are always included either. But one fact remains, it's not just the US throwing in debt. The US national debt is over 36 trillion. Japan owes around 9 trillions. India about 3. Brazil roughly 2 trillion. And that is growing faster than the global economy. The snowball keeps rolling. Okay, even if we agree on the number, who owes that debt on the other side? Because every debt is someone else's asset. We all understand how that works, right? One side must pay, the other side has the right to receive. So who is this big, scary beneficiary? Originally, it was simple. Your neighbor was starving. You lent him seeds. 6 months later, he returned the seeds and added some firewood as interest. Government started doing the same thing. A king needed money for an army, a fleet, or a castle, so he sold promises. Lend me money now and I'll pay you back with interest next year, but not before. That's how government bonds were born. Debt with interest guaranteed by the state. The system stayed relatively clear until 1944, the Bretton Woods Agreement. The dollar was tied to gold. After World War II, the US held about 70% of the world's gold reserves. That gave them the gold button. They could print dollars the whole world used for trade. From that point on, money became more about promises than real backing. Remember that. In 1971, Nixon abandoned the gold standard completely. The Bretton Woods system collapsed. Now governments could create money with far fewer limits. The result? In the early 1970s, the global debt was about 100% of GDP. By the late 1980s, it had doubled. China owned trillions in US bonds. Japan became one of the largest foreign holders of US debt. Europe financed the US and invested in China. But who originally lent all that money? Mostly us, ordinary citizens. Around 70% of many countries' debt is owned domestically. In Japan, it's about 87%. In Europe, roughly 25% to 50%. Here is how it works. When you deposit money in a bank, it doesn't sit under a mattress. The bank lends it out or buys bonds, including government bonds. So without realizing it, you are financing your own government. No secret shadow rules, no hidden masterminds. The government issues bonds, investors buy them. That's it. And it's not just banks, pension funds, insurance companies, investment firms. They all buy government bonds. Your future pension is probably invested in government debt. If you insure your car, that insurance company has likely invested your premium into government bonds. Large countries mostly borrow from themselves. The government pays interest. Investors receive it. They buy more bonds. The cycle continues. Globally is the same. About a quarter of Eurozone debt is owned by foreigners. Japanese savings become loans in Chile. Chinese reserves become US bonds. The global system is basically moving money from one pocket to another. with an IOU attached. The machine keeps spinning. Everyone's happy. As long as everyone believes those pieces of paper will still be worth something tomorrow. It always starts the same way. Trust falls. The lower the trust, the higher the bond yields. It's like betting odds. Lending to a risky country isn't the same as lending to a US or China, but higher interest makes debt harder to pay. So countries borrow new money to service old debt. That's the debt spiral, the engine of the modern economy. Scary? Yes, but without it, the system doesn't work. Look at the US. Last year alone, it spent over 500 billions just servicing its debt, more than on defense. Can you imagine that, guys? Most new borrowing goes towards paying old interest. This cycle has lasted decades. Why is this possible? Because developed countries run on trust. Strong economies, transparent institutes. As long as people believe in the dollar, the US can borrow cheaply. If that belief disappears, the game changes. In 2012, Greek 10 years bond yields hit 30 percentages. Investors expected default. The country had to cut salaries, fire public workers, and its economy shrunk by 25 percentages. When trust vanishes, options are limited. Venezuela printed money instead of borrowing more. The result? Hyperinflation. Prices doubled within weeks. The currencies collapsed. Inflation is the hidden tax. While you hold cash, its purchasing power melts away. But printing money isn't always evil. If the economy grows faster than debt, the debt gets dilated. After World War II, US debt was 120 percentages of GDP. 30 years of strong growth reduced it to 30 percentages without default. There is also austerity. Cutting pensions, salaries, raising taxes, looks good on paper. In practice, recessions and protests, like Spain after 2008, when unemployment hit 26 percentages, guys. We live in a system built on debt and trust. It works as long as investors believe someone will buy yesterday's debt tomorrow. And it can continue for a long time if one golden rule is respected. Debt must not grow faster than the economy. Eliminating government debt completely would require a completely different economic system. Debt isn't a mistake, it's the foundation of modern finance. Pensions, bank reverse, insurance funds, they all rely on government bonds. Without debt, growth slows dramatically. No investment means no technology, no research, no progress. It's like taking a loan to renovate your apartment so you can earn more later. Tesla started with billions in debt. Investors believed and funded the future. Elon Musk didn't become wealthy just by selling products. He convinced people to invest in tomorrow. Without debts, progress would take centuries. A government is like a massive corporation. Instead of products, it builds roads, schools, infrastructures. Taxes alone aren't enough. That is the oxygen of development. But remember, when the system breaks, ordinary people suffer. Defaults wipes out savings. Inflation empties bank accounts. So what should a trader do? Global debt is not just an interesting fact. It's a pressure map. Don't look at the how much a country owes. Look at the how much it pays each year to service that debt. When debt servicing approaches a quarter of the national budget and the economy slows, there are usually three options. Print money, borrow even more, cut spending. Every scenario hits the currency. Typically, the chain reaction looks like this. Bond yields rise, trust falls, capital leaves, currency weakness. And this signal appears long before dramatic headlines. Bonds are the radar of the future. The debt market reacts first. Rising yields and widening spreads mean big money is moving into safety. Volatility is coming. Watch central banks, not politicians. They only have three tools: raise rates, print money, control yields by buying bonds. Money printing supports gold, commodities, and risk assets. High rates strengthen currency by pressure markets. The most dangerous moment, when everything looks calm. Record that, markets at all-time highs, a sense of control. That's how crises in 2008, 20, and 22 began. The logic is simple. Debt affects rates. Rates affect currency. Currency affects liquidity. Liquidity moves assets. Understand this chain and you stop guessing. You start seeing the market several moves ahead of the crowd. Every day you live inside a global debt structure. Your salary, your currency, investments all depend on trust in these numbers. So keep an eye on that. That's where major trends and major crashes are born. Congratulations! You just become a little more financial literate. If you are interested in not just in what's happening, but in how to profit from it, stay with me. Subscribe, hit like. Sarkis was here. See you in the next video, guys.